Welcome to the Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
All right, welcome back to the Weekly Trend podcast. This is David Zarling. I'm here with the leader of the Lost Boys, Rufio McMillan. Today is Friday, April 17th. The S&P 500 closed at 2874. Another important and big week in the market, as they all are. Lots of things to discuss today. Ian, is there any place you wanted to start?
I think we start with today.
Yeah.
And pretty big move today. Obviously some positive news regarding vaccines and things like that. And a great close.
Right. They took it up in the overnight futures market and had a gap open on this Friday. Price sat sideways for most of the day, and then they closed it strong at the end of the day here to close out the week strong.
Yeah, I think some people thought that this morning gap up was for sure had to be it. That this had to be too much.
Right.
And it was not.
Yep. Until the next day, right? Like you just continue to take it day by day, week by week, manage using risk levels. That's what makes us adaptive. One of the things that was interesting this past week, as our clients know, we started adding back exposure even as far back as last week, maybe even the week before that. But one of the things that we started seeing this week is some individual stocks, not just broadly, broad sectors like the S&P 500 and the NASDAQ 100 and Russell 2000 and things like that. We're talking about like just individual pieces that are showing some strength that is notable. Do you want to talk a little bit about that?
Yeah. So, like you said, started adding exposure really a couple weeks ago, and then really moved into it when we solidified 2,600. That kind of moved up to 2,640 for us.
Right.
And then once we got through there with some conviction, it was really game on. Came into the week with some pretty good exposure to stocks, some really strong exposure to stocks. And yes, something we typically see in strong markets, something that we're more comfortable with is when individual stocks start to show solid setups. And we definitely had seen that really starting last week and then again into this week. So for those clients in the growthier models, they will see individual stocks in their portfolios now, which is something we haven't seen since the top in February.
Right. So we're, each of our models is a little bit different. Each model has a little bit different equity exposure, depending on the risk tolerance within that model. But to your point, individual stock setups really not apparent until recently, like they were back as far back as February, and because it's showing we're out of this liquidation environment a little bit here.
Well, exactly, and I think they're obviously, so going back to liquidation, I think if you're someone that likes to buy stocks at a bottom, or you're trying to time the bottom, obviously more setups, even well before the last couple of weeks, going back to late March. But for what we do at Adaptive, it's a little bit more of a breakout style. So really starting to see those pop up. And in particularly in the healthcare sector is where we had noticed a lot of strength over recently, a lot of relative strength.
Sure.
And so, really that and healthcare, or I would say healthcare and tech, up until today.
Right. And really, when you talk about, I should back up a little bit. When we talk about liquidation, what I mean by that is there are times in a market where you might have some stocks going up, some stocks going down. There's bifurcation. There's not necessarily this high correlation scenario taking place. But really what we started to see in March was this unification of stocks, meaning this full liquidation taking place, about mid-March to the end of March, where
people just wanted out. They didn't care what the ticker was.
It didn't matter what the stock was. It was getting sold.
Mm-hmm.
And we're now seeing some of those individual stocks come back that are showing their relative outperformance that almost have a look like they should have never got liquidated
exactly.
in the first place.
It's the stocks that have come back quickly where just based on the price behavior, you can tell that they were the last to be sold and they were the first to get bought back up. And again, we saw that in healthcare and tech.
Right. Yeah. Tech, major outperformer alpha wise this week. Little bit of reversion on this Friday, which is perfectly normal and fine.
It's great. And I think it actually kills a lot of the negative theses out there.
Well, right. And you really had, you could argue, when we talk about it's one thing with small caps to have them participating. They don't need to outperform. We've covered that a fair amount of times on this show. Small caps don't need to outperform, but it's nice when they participate. And you could argue they were on the ropes Thursday.
They were, yeah.
And so what we saw on Friday was extremely healthy, because without this Friday, you really didn't want to see small caps using something like IWM breaking below 160 or staying below 116.
You didn't. Small caps not really wanting to keep up. It was a big argument. So we saw some bad breadth numbers a couple of days this week on green days, like 40%, 35% type up days on green daily candles. And it was this argument that, it's only tech holding it up, which is okay, right? We know, right? We harp on know what you own. We understand how the indices are weighted. Indices can stay elevated. They can hold up with tech outperforming, and it can mask a lot of the questionable behavior going on underneath the surface.
Well, yeah, right. So going into Thursday evening, you had this scenario that had kind of developed over the prior, I'll call it 10 days, where you did have the big cap or mega cap names performing the best, holding the market up while small caps and everything were kind of falling off and on the ropes on Thursday. And really there's two solutions. That's a thin market, right? There's a few stocks doing very well while the rest are not. And there's two ways for that to resolve. We kind of know how that resolved in February, right? All of a sudden the mega cap names started catching down to everything else.
Yep.
But the other way that resolves is when the underperformers or the small caps, those type of areas start to outperform. And maybe that was the start of it on Friday today. Maybe it wasn't. But having those participate is important information. And we saw that today.
It's a big part. Like I said, a lot of people have been harping on, this rally can't go higher because small caps aren't participating, and the ripple effect of that. But now we saw people really wanted banks, regional banks, major banks, things like energy, to really start to, again, the small cap outperformance doesn't have to go on for weeks and months. But they desperately needed to get back up. IWM needed to get back up above 120. We gapped up above that today, closed above 122. And we got it today. So that has really kind of nullified that thesis. If we see it carry on, similar to 2016,
right,
we're prepared for that. Like we talked about last week on the podcast, as clients know, we talk about this a lot, and we talk about it a lot on the podcast. Growth has continued to outperform over the last few years. That doesn't mean we can't go back to 2016. I think it'd be incredibly healthy to have that type of environment.
Right. Rotation does not hurt anyone.
Rotation, and that likely means higher rates. Banks do well, energy does well, gold miners probably do pretty well, which we'll get to later on in this podcast.
Yeah. Can you elaborate on? We kind of talked about the small cap development today, and again, it's one day.
It's one day.
It's one day, but something else we noticed this afternoon was treasuries, bonds.
Treasuries, you're right, have been strong.
Stubbornly strong. All week.
It's a great way to put it. And they would buy them at the close. They would sell. They would kind of fade throughout the day, and then we'd get these last hourly candle bars where they really bought bonds up into the close every day. TLT hovering around 170, really all week.
And let me be clear: we're not people. We're not. Our investment process is not. Stocks and bonds are inversely correlated. They can both go up together.
Absolutely.
They can both go down together. You name it, they can do it. But it is notable.
It's more about rates,
right?
And what the ripple effect from that is, right? Because rates can keep going down, and then growth most likely outperforms, and we can keep on the same train we've been on since January 2017.
Right. If we keep having rates that collapse, and because the majority of the world, right, is in negative rate territory. In the U.S., not yet, or maybe never. I don't know. But a thesis out there is that the U.S. would follow, and we'd somehow end up in a negative rate environment. I have no idea whether that's going to be the case or not. But to your point, and you've been very strong about pointing this out, that if we're going to have rates move higher and banks participate, then that's good things for small caps.
Very good. Banks are a huge weighting. Financials are a big weighting in small caps, and banks are even large. They're a huge part of financials.
Right.
In that small cap sleeve of financials, regional banks are a big part of it.
Right. So a thesis that's out there is, if today was a failed breakout in long duration treasuries, and we're going to see pressure on those treasuries now, that means higher rates, which in theory would support banks, which would in theory then support small caps. But we don't have to overcomplicate things. Each chart is its own.
One thing I wanted to get your opinion on was, how are you feeling about, we might talk about this more than anything with our clients, whether it's on this podcast, whether it's in market updates that go out, whether it's lunch and learn. We talk about sentiment. What have you noticed out there, maybe over the last week, or maybe not since the bottom, but since, I'd say over the last 2 weeks, maybe it's gotten a little bit louder, but what have you noticed personally in regards to the sentiment on whether, this market rally can last?
Right. I'll start in two different directions here. I would say big picture wise, you and I both know that price moves first and then the news moves second. And price can change people's sentiment very quickly, and sometimes not so quickly. And so, it's kind of back to the old adage that wet streets don't cause rain, right? It's the other way around. Same thing, price dictates sentiment. So while we've seen the last 2 weeks move something like the CNN Fear and Greed Index off of extreme readings, I think you would agree with this, Ian, that what we're seeing maybe among some peers or those within the industry is a little bit of disbelief. The way I would like to put it. I think
we see it on the institutional and retail.
Right.
It's definitely happening amongst the professionals,
right.
And it's definitely happening amongst a majority of retail traders.
Right. And it goes back to, and we talked about this before, that it's likely that the market's going to provide the signal before the good news comes out. And, with a rising market, there's disbelief, right? Because we're still in this coronavirus news cycle, which is appropriate because, coronavirus and shutdowns and reopenings, et cetera. I get it. But similar to how markets sell off and then the bad news comes out, you can have a market rebound before the good news comes out. So I do sense that there's a little bit of disbelief. Whether that's something that sustains and the market keeps moving higher, I don't know. How about you? What have you noticed in that area?
I think there's a lot of disbelief. I think that they're coming off of this. There were a lot of people expecting a 2011, 2015 type retest, which it made total sense, right? The evidence pointed towards some type of double bottom scenario here around 2200. Maybe we undercut it a little bit. There was a loud minority out there who likes to harp on 1932 and all of the correction or the bear market counter trend rallies that we had. But I still think that there is a lot of
negative sentiment. Yeah.
There's a lot of negative sentiment because people and a lot of the feedback has always been led with, it's when people question you about the market going higher, it's always led with some type of headline that, to be honest, seems to be centered around fear and that the economy is so bad that the stocks can't keep going higher. And what we know as technicians is that the stock market is not the economy.
Right.
On a grand level it is, and like a 2009, but from a week to week, month to month standpoint, the market is not the economy. Right.
And that's very hard for some people to grasp because, right, the market is a future discounting mechanism. So we're looking at the prospects of companies and economies and societies 6 to 12 months into the future. It's not about in the moment. It's about what are the prospects of the future. And that's what the market's continually doing on a day-by-day basis.
And another great example, the same example we've used the last 2 weeks, another jobs report this week. It was horrible. Well, we were up 3% today in the stock market.
Right.
So we got to get off this, that because a jobs report is going to be bad, that means stocks go down. That is not how it works.
Well, and investors then need to be ready for the inverse, right?
They do.
What about when all of a sudden the great news about COVID, we start reopening and we have great jobs reports and the market sells off?
And that's definitely a possibility, right? We're hearing a lot of these March 1st dates from various states or various governors, right, that's a target. If we rally for 2 more weeks in the March 1st, and then we start getting good unemployment data, right? People are starting to get back into work, especially maybe those that were simply furloughed instead of laid off. And the data starts to get really good and life is back to normal and we're all at our favorite restaurant and we're all out at the Brewers game. There is a potentially, right? This works both ways. Climbing a wall of worry works both ways.
Right.
You can fall down a hill of good news.
Right. You can be buying the rumor and selling the news. And like you said, it works both ways. And that's why as part of an adaptive management process is you develop your theses, your different game plans.
You have your price levels.
And you have your price levels. And price is going to confirm or deny that thesis. Period.
And going back to the price levels, which again, to this point, clients, it might be another thing clients and listeners are tired of hearing now, but it goes to, we talk about And we talk about it a lot on social media as well, is having these predetermined price levels. They haven't predetermined price levels haven't led you astray during this rally. I'll tell you that.
Correct.
There's nothing about 20, yes, we had it took 3 attempts at 2,600 to get through, kind of. But once we got through there on April 6th, and then again, these predetermined lives that we've used, 2,700, 2,710, 2,750, 2,800 to 2,810.
Right.
I mean, these are price levels that you, Kevin, and I talk about
nonstop.
I mean, nonstop throughout the day.
Right.
And it's been a grind through them. I'm not saying that they've been, but if you've been patient, I will say, again, I think we did a lot of sitting in our hands this week. We added, but we already had pretty good exposure coming into this week.
Well, right. We had that.
And there were a lot of sitting on hands this week where, markets got a little antsy, whether it was the Monday morning kind of sell-off was a little.
You gap up and then you sell it. Yeah.
Yep. And then we gap up the next day. Then you had Wednesday and Thursday. But really, I mean, we've almost got this island bottom now, if you want to call it that. I'm not going to call it an island reversal, but some type of island continuation. That's
right.
Probably not a textbook technical analysis term,
right.
but
it's a little bit about essence there. But to your point,
it's more about essence, exactly.
You had a move out of 2635 on April 6th, and since then we've been making higher highs and higher lows. It's a very definition of an uptrend. And yes, it has narrowed into large cap names through Thursday. And then we had some rotation into small caps and
huge rotation today.
And so that's a quality thing. Now, will it continue next week? No idea.
I don't know.
What I do know is we've harped a lot on, implied volatility, such as something like the VIX, which has been near 40 now for a little while. And I kind of wanted to give people a little bit of perspective of what has this rally, whether it continues or not, looked like comparatively with a VIX at 40. It's definitely had some implications on price movement, absolutely on the downside, but we've also seen it on the upside here.
We have. It's been a grinder.
You had a great chart that you put out comparing, performance versus time. Can you take that further?
Yeah. So off of the Christmas Eve 2018, we all know that it was a miserable day, but it did end up being the lows.
Right, an important low.
And a very important low, a very important behavioral low that we talk about constantly on the podcast or on social media. So off of the Christmas Eve 2018 bottom, I think on the 24th, VIX had peaked at 40, 50-ish. No, 40. Yeah, around 30, 36.
Yeah, so not even where we are.
Not even, still above where we are today.
Right.
And we had a very smooth ride down. And we were back under 20 by January 9th. We were back under 20 in the VIX on January 9th. So back under maybe 1% move days. By the end of January, we had a VIX of 16. A VIX of 16 in roughly a month compared to today. And it was a quick V to bottom compared to today. So on the March 18th high, it's not where markets bottom up, but the VIX high, March 18th, intraday high was 87.
Right, 87.
We have now come off the lows, roughly 30%.
Using the S&P 500.
Using the S&P 500, and VIX is still at a 37. And remember, we just said it topped out at 36. And when we talk about this rule of 16 and what this means for intraday moves, It's been a much different bottoming process. I would say still not as funky yet as 1987.
Right. Not as funky, but that great chart that you shared was basically from the Christmas Eve low,
Yes.
seven months out in the S&P 500. So
That
December
would have put us at what?
2018.
Late July?
Right. So
July?
late July, that's a 29% increase. So
Wow.
it took 7 months to get 29% off the low.
Mm-hmm.
With a VIX at 40, we've now had 3 weeks with a 29% move off the low. So it's an amazing difference because of the implied volatility. And we always talk about,
Yes.
like, we're never going to be able to catch a bottom. It's not about
No,
catching falling knives. That's just part of the
it's
process. We were
not.
able to protect on the way down, and we've been able to participate on this move back
There
up.
was a lot of
Obviously,
alpha to work with for this bottoming process, which is
right.
another benefit of being able to get out late February, early March.
Mm-hmm.
And that's why, again, we're not going to call bottoms. That's why you've heard us harp on 2600, 2640 as being this, okay, if we can get above here, we've probably created some type of short to intermediate term base.
Right.
And it has worked well.
And so as long as we're above there, we can have some exposure. That's not
Yeah.
recommendations to everybody, but that's what we're doing on behalf of our clients. But as long as we're above that level, you can have some exposure. Below that, the thesis changes, the game plan changes. We've had plenty of people talk about a retest. Maybe it wasn't a retest in the S&P 500.
Yeah.
Maybe it's a retest in some other industry group, or like small caps, or
you had even, I believe, pointed out crude had
right.
a retest and undercut.
Right. Maybe this is the retest in oil. We have oil sitting at 17, 18 bucks a barrel. That's pretty important information as far as retesting the prior low.
So it's interesting you say that. And with small caps outperforming today, something we had brought up last week was this: okay, if we're going to see banks and financials outperform, if we're going to see energy showing some positive signs, there's a great chart from a research firm, Strategas, that they put out today with crude oil making a double bottom, but high yield energy spread selling off. Again, we'll probably get more into that in the extended version. But if we're starting to see these value sectors and value sub-industries trying to inch their way to the head of the pack, while we've been on the growth train, and clients see that, I mean, we're long semiconductors as well right now. If there's no problem flipping over to that, if we get a 2016 type environment, I don't see why not. I would love to own banks.
Right. There's no need to marry our opinions. If things change, we'll change.
Energy's been horrible, but if the evidence shows up on a relative chart.
Right. If this is an undercut in crude, meaning that we took out the prior low and then we recapture it, now you have some risk levels to manage with. That would be a tailwind for energy, which would also be a tailwind for small caps, or value, if you want to put it that way. So we can switch between value and growth. We don't have to be so factor focused, myopic, that we're only looking at, oh, it has to be small, it has to be value, and that's how we're going to be tilted. No, when value has momentum, we'll own it. Kind of jumping to some of these, and we don't have too much time left here in the client portion here, but I kind of want to touch base on, we kind of talked about big cap or mega cap, and we really saw it out of, let's call them I know JC Pretz likes to call
names.
JC Pretz likes to call them the mega names.
That's a great acronym.
Right. Microsoft, Apple, Google, and Amazon. That's what we have seen. That can continue. It doesn't have to. But it's really interesting to see those big four names.
And Apple and Microsoft, I mean, they're just so important when it comes to the broad indices. Apple is the number one. It's the number one weighted stock in the S&P. It's the number one weighted stock in the Dow. I know United Healthcare was close.
But these are the all stars, right? These are the guys.
United Healthcare is now the number one stock in the Dow. It's price weighted index.
Well
so
done,
Apple's
United.
number 2, but broad argument here. Large cap growth, very important to the indices. They can carry them a long way. Apple and Microsoft can mask a lot of bad things going on underneath.
Right. And so this goes back to, we want to see the league does better when the stars do well. And I know you're a Chiefs fan. I'm not.
Mm-hmm.
But I don't want to see Mahomes get hurt, because I don't think that's good for the league. And so same thing with some of these bigger name stocks. I don't want to see them necessarily get hurt. We don't want to see them fall off. Now, it would be information if they did. If some of these started to get sold, it would be information. Now, they can also consolidate while value catches up. That's another opportunity too.
Mm-hmm.
And so we can navigate these things, obviously, using the visualization of data or supply and demand price on charts. So with that, since we're bumping up to this time limit here for this section, anything you wanted to wrap up with here before we go to the extended version?
I will say that, and I think Jim Cramer put this very nicely the other night. We had some positive news about vaccines for the treatment of this coronavirus coming out, being ready earlier than expected. And I think that there seems to be a lot of negativity met towards good news coming out. I think we're in a time where a lot of people are feeling angst.
Right.
They're feeling nervous about the prospects for our economy. Probably a lot of people out there feeling a lot of financial stress right now.
Right. Real people, real jobs, real
Exactly.
businesses being affected. Absolutely.
So we're seeing a lot of just negativity. I think in a market participant sense, a lot of disbelief in the face of some really good news. If you're someone that's been tracking data, we don't really track the data to make investment decisions. In fact, we don't at all. But
you're talking about like COVID data and stuff like that.
COVID,
yeah, right.
And
right.
You see hospitalizations come out. You see local governments and state governments saying we're ready to open back up. We want to put people to work. I think that's an interesting tell for where we're at. I do see that as a contrary indicator. I do think that a lot of people still do not believe the stock market will continue to go up. And again, I'm not saying that things get better for the economy and for Main Street and for small businesses in the next few weeks. But going back to our point we, really harped on earlier, the market is not the economy. There's a lot of people that are adamant that stocks need to sell off.
Right. And and we know that the market knows more than all of us. Meaning it knows more than you, knows more than me, knows more than our listeners. And that can be a very hard pill to swallow, that the market's going to do what it's going to do and that it can know more than us. But to your point, a rising market can provide optimism that we are turning a corner in some of these areas, whether it's solutions like hydroxychloroquine or a vaccine or some type of treatment method, or that, there's more people that were exposed to this than we thought. And so the death rate is extremely lower than we thought. There's all sorts of possibilities out there. As long as we stay disciplined to price, that's, a reflection of the prospects of these things going forward in time. If we say disciplined to price, we're going to be just fine. We can use those price levels, manage risk accordingly. And we'll continue to be optimistic because
absolutely, we're both glass half full type people.
Right. We think America's a great place.
And
we think America tends to overcome.
I think America constantly, time after time, beats expectations about how bad things are going to be. It's only in our nature.
Right. It's part of who we are as a country and as a people. And so I'm not going to be in a scenario where, no, stocks may go down again. That's not what I'm about to say next means, but I'm not going to sit there and bet against Americans. Now we'll see what the weeks and months come from this in the future. We might look 12 months from now, look back and be like, wow, what was that all about? And obviously we'll be able to point to a panic type situation with a pandemic on our hands. So we'll see. We'll take it day by day, week by week. That's what we continue to do. But I appreciate your time during this client portion of the podcast, and we'll continue on with the extended version here shortly. Stay tuned.
Have a great weekend, everyone.
All right, digging into some more detail in this extended version, Ian, we kind of touched base on oil a little bit, potential for maybe a retest, maybe it continues lower. We don't know yet. We need more data. But it's interesting. You talked about the chart we saw recently regarding energy industry high yield bond spreads.
It's an interesting divergence.
Right. I think so too, that you could have those spreads blow out and now pull back in, while maybe there's a bottoming process here in oil. As the chart kind of alluded to, we kind of saw kind of a similar situation back at the beginning of 2016.
Absolutely.
So really great chart. Really interesting.
So yeah, energy spreads coming down. I could say energy is probably as important to the high yield bond sector as tech is to stocks.
Yeah.
And so to see energy spreads, which are the spreads amongst high yield bonds issued by energy companies, to see those continue to come back together and tighten, even as an asset like crude that's so tightly correlated to companies and their top line revenues, to see those tighten, which is a bullish, even as oil came back down to retest the lows, I think is a really positive development. So if we've got energy spreads tightening, that means we know we have broad high yield spreads tightening. I think that's a pretty bullish sign going forward. Again, the last time this happened, we didn't really get a divergence per se in the two, but the last time oil spreads peaked around this level, was early 2016.
Right, when they started pulling back. Yeah, absolutely. And so we have this scenario on our hands where we had a few weeks here of let's call it a narrowing market, where your mega cap names led, and some of these other areas lagged behind, with small caps on the ropes on Thursday, and then they rose. And so we have this kind of scenario of disbelief right now. What other things are we seeing that's kind of informational, whether it's among retail investors and institutional investors, that's interesting to note?
I think Ryan Dietrich had a really good piece of data put out going into yesterday's session. I believe institutional investors were at their highest cash levels. I don't know if it was in forever. I know it was higher cash levels than 2008. Right.
So abnormally high levels of cash. And when I say abnormal, just meaning extreme levels of cash in the current scenario. And that has tended to be contrarian. Whether that follows through in this scenario, we don't know, but it appears to be.
I think it's interesting that they've even been raising more cash throughout the rally.
Right.
So as stocks have continued to go up, there seems to be more disbelief, and that there's this idea that, yeah, of course I'm going to raise cash because I want to have cash ready for the retest. And
right. And there could be a retest.
There
could be. I mean, and what, in a process, in an adaptive process where we're pre-identifying and we're game planning prior to the event taking place, I think we could talk about a place like 2813 or 2766, or, these are levels we would see broken beforehand that would lead us to increase the odds. Like you said last week, we're dealing in probabilities that would
Yes.
increase the odds of a retest.
Yeah.
But until we see those levels broken,
I mean, you got to get through 2840 to get to 2800.
right? It's
You got to
math,
get
right?
through 2800 to get to 2735.
Right. Numbers themselves work linearly. You just don't get to walk around one of the numbers and pretend that didn't happen. So we have these levels pre-identified, and the probability of those theses coming to fruition increases as you break below those numbers going forward. But it's interesting to note that we have these institutions raising cash or continuing to
As
raise
stocks
cash.
move higher.
Right.
And if stocks continue to move higher, to be honest, they're going to have to cry uncle, and they're going to have to step back into the market and start buying.
Right. So there's two things that we talk about all the time is if we have a high level of put buying, or you have a high level of cash raising going on.
And they bought puts. It's another thing you and I watch every day.
Right.
Is we watch the put call ratio, and every single day this week it continued to climb. It would start out at 930, somewhere in the spot 8.85 range, and I think every day this week, I think 3 out of the 5 days we closed above 1.0, and all 5 days we closed above 0.9.
Right, and so you have basically what you have, what you're alluding to there. Is if you have these high levels of cash, and some people like to use the term quote unquote cash on the sideline. I'm not really a big fan of that term, but a high put buying environment, a level where there's high cash, all that is tinder. That's just fuel waiting to be lit.
Yeah.
That's demand, right? That's any cash or put that's on the wrong side of the trade is future demand. Now, they be proven to be right on the right side of the trade. I have no idea.
Absolutely.
We could be talking 2 weeks from now in a much different way. We've broken these certain levels, and now we're in a different scenario. But to your point, higher cash levels, put buying, these are potential fuel for upside demand. We don't know if that's going to be the case, but why don't we kind of go through some of these lines in the sand, these areas of potential support, or resistance, in some of the important areas that we'd like to look at that might provide our listeners a framework or something to look at in the weeks coming up here. So any areas that you're looking at, and whether it's resistance or support that you want to jump through.
So I guess going major index by major index, I think we want to see the NASDAQ get through 9,000, 8,900, probably more so 9,000. The 78.6 Fibonacci retracement on the NASDAQ is 9,100, which essentially brings you down to it brings you back to the February 24th gap down, which would be a heck of a spot to come back to. And as long as it holds above 2,500, which is really this gap up we saw on the 15th, big daily candle on the 15th, inside day followed by 2 higher days. I know on the S&P, obviously the most talked about index, probably the closest watched among the adaptive team. Want to see it get through 2890, 2900. There's a gap there from March 6th. We'll gap down on March 9th, that Monday, that needs to be filled. But those were the lows for March 6th. We had a good close that day, but as we know, big gap down. And you and I kind of talk about that as when the real liquidation started.
Right.
I would say March 9th is when you go back and look at individual charts, and you've noted this as well, is when you just start to see the volume flowing in. And it's everywhere. Stocks that had held up fine before that start breaking support on the 9th.
Right.
And that's kind of where if you want to talk about forced liquidation, so staying up above that level, which is 2750-ish, I think is a pretty good, again, behavioral price point. Russell
if you pull up a chart, that's a very logical area where you would expect buyers to show up again if we pulled back to that area. And if they don't, that's information.
Absolutely. Buyers not showing up where they should, like we saw in bonds today, is information in itself. I think on the Russell 2000, the weakest of the three, it did have a great day today. Russell had a great day today. We didn't go into day overweight small caps, I'll tell you that.
Right.
But that's, going forward, I'm not going to sit there and ignore it if we continue to see outperformance.
Right. And I would encourage, if you're a technician out there listening, take some time this weekend, do some ratio analysis of, something like IWM versus some of these other things. And you get some pretty clear levels.
You do.
Where you can start shifting. Again, not recommendation, not investment advice. Everybody's an adult on here.
Yeah, because we've seen these pops in relative strength before. We saw it right off the bottoms on the, back on the 18th through the 24th. We'll see if it has follow through.
Right.
But definitely needs to participate big time. It needs to get back over 1250, 1260. That is the December 2018 lows. It's the only index that hasn't gotten back above that. And I think, foreign, I know two that you love to follow are the DAX. Do you have any levels there that you're kind of spotting?
Yeah, I think, the DAX being something that's extremely correlated to U.S. markets, the German stock market, I think staying above 10,300, really important information. Below that, information changes, or the thesis changes. So I think 10,300. I know we like to follow the Nikkei. I think that's staying above something like 19,000 is important information. So those are some really good lines in the sand. I know last week we kind of talked about potential areas of support that we'd like to see hold in some, let's call them sectors. So we kind of talked about some broad indexes, both domestically and internationally. We saw industrials hold the 60-61 area this week.
Yes.
Right. That's a good thing. That's from a bullish thesis perspective. Nothing wrong with that. You could
call it a failed breakdown.
Right. That's important information.
So we're back over. Those were the highs from 2015, 2016.
Yeah, great.
Finally break out. So we finally break out. We're basically back to the same behavioral standpoint we were election night 2016.
Yeah,
industrials pop, financials pop. That November, December, and we talked about this, I think it was 2 weeks ago. You went into 2017 like, all right, we're going to get this is a continuation of value. Obviously, as we know, growth flipped. But back to that same behavioral, people are saying, okay, I'm willing to buy industrial stocks at the same price I was in November. Almost 3.5 years ago.
Right. And you look at something like XLI and just looking at where it closed on the 16th. So just a day ago on Thursday, I think that's really important information that we were able to hold a close like 60.27, which matches up very closely to that December, that Christmas Eve low. to me, the fact that you're able to hold that level in XLI, an important sector like industrials, is important information.
It's important. And we saw Jets Airlines had a big bounce back today, which is important for industrials with transports there. Trucking stocks have been pretty good.
Yeah.
Obviously, I mean, we're having to ship. There's a lot of online delivering going on right now.
Yes. Yeah.
So yes, stocks like an Old Dominion, railroads have been not too shabby. I mean, you've got, I think Kansas City Southern's a great example of a stock that probably should have never been liquidated, should have never been sold. Again, a stock that on, again, March 9th breaks down below its a big time support level.
Yeah.
Within about 2 weeks, it's back up above. And so, I mean, and as far as, a stock like KSU is concerned, I mean, we're right back to where we were in November.
Right.
So if we think about the behavior that went on there, I mean, I'm not saying there can't be short-term, corrections, but just there's a lot of important stocks back up above breakout ranges that tells us, okay, I'm ready to kind of reset here.
Right. We had technology XLK hold above 80/30. We had financials. That was one we had been really watching this week as
Big
far
time.
as there's a lot of pressure on those guys, and financials holding above 2150-ish, really important. Consumer
Huge.
Discretionary XLY holding 100. Even something like a ratio of XLY, XLP, so discretionaries versus staples, been quite a whipsaw here lately, but holding an important area.
I remember, yesterday, the three of us sitting around and saying, banks cannot go any lower. Banks cannot go any lower. And
right.
They came through today.
Not from a disbelief standpoint,
exactly.
But from a thesis standpoint.
Exactly. Not saying that they can't, because I'm so bullish this can't possibly happen. I'm saying where if banks start breaking down again and we're rolling over, that's just it's just not good for the broad markets. And they came through today, sold bonds, rates ripped higher, banks and regional banks really two of the top performing areas today, but really took some people to the edge of their seats.
Right, and the market's great at that, right? The market's great at making people squirm, and we use those price levels like we talked about in the past. You look left to game plan right, and so you look on a chart to the left and you find those important areas that could be potential support, resistance, and you watch how price interacts. And so we're beholden to supply and demand, and that's okay because that's law, not theory, right? So in our notes here, we've got something on here that I want to touch on, and that's a chart that Shane Murphy put out. And can you elaborate? Can you talk about that chart that I think it's an important and interesting one that he shared?
Yeah. So Shane Murphy, a great younger technician, also works in the RIA space. And he had showed a chart last night actually before today's big move in yields, which we saw, of the correlation between the ratio of stocks, the S&P 500 to gold, and then how tightly that's pretty correlated to U.S. 10-year Treasury yields.
Right. So you're talking about so just to summarize that real quick before you can, you're talking about a ratio chart, taking the S&P 500 versus gold, then overlaying that versus U.S. 10-year Treasury yields, and recognizing that it has a tendency, not always, it's not always a 100% correlation, but it's very close. So in an important relationship. And so continue, go ahead. I just wanted to paint that picture a little bit for our listeners, but continue on. It's a great chart.
Yeah. So as we've seen this ratio between stocks and bonds or stocks and gold move higher, it's kind of as implying that we hadn't seen the move in yields yet, but kind of implying that yields should probably be playing catch up here soon.
Right. One or the other.
And as we saw today, rates, or again, that's very true, or stocks need to play catch down. But rates did move higher today. Again, pretty highly correlated relationship, usually up above 0.9. And so again, we talk about the ripple effect there for higher yields and what that means for various assets. And then
right. If yields are playing catch up to that ratio of S&P 500 versus gold, that has ramifications across the things we talked about earlier, whether it's banks or small caps, things like that. Stocks can also, that ratio can also catch down.
It can.
Which, if that's taking
place.
And
it has before.
Right. It has before. It can. But it's a great chart. We wanted to highlight it. It has ramifications if, like you said, Ian,
yes,
if yields are catching up, that has ramifications for allocation decisions.
It does.
Based on certain segments of the market.
If regional banks or exploration, energy exploration production stocks or gold miners, which there's been a lot of relative strength in gold miners. If you follow us on Twitter, if you follow the Adaptive, we share a lot of our proprietary relative strength rankings and absolute rankings. Pretty much a lot of the data we're using day to day to make decisions. Where are we finding strength? Where are we finding weakness? Gold miners have been up there, whether it's a Barrick or a Newmont.
Yeah, gold miners, yeah.
Now, there's some divergences going on out there. We'll see what happens with gold, particularly gold miners on a relative basis.
Ian, when you say divergences, you mean like RSI, like relative strength?
RSI divergences of where we'll see. They need to break through them. They absolutely could. I will be honest. I think a lot of the gold miners show the characteristics of these stocks that we talk about probably shouldn't have been sold.
Yes, I was just going to ask you about that.
They got bought up real quickly. And so there were some gold miner volatility.
Oof.
And this was back mid-March.
Right.
The 13th if you were to look at a GDX or a GDXJ on March 12th through March 17th.
Right. The ETFs for gold miners and gold miner juniors. Yep.
Crazy, like back to back 20, I think 4 days in a row, gold miners had a minimum of a 20% range.
Yeah, that sparks flying off the page, man. You're looking at the chart.
And that blows out anything you'd ever see from the S&P or large cap names.
But that goes back to that liquidation period where it was people just selling, like whatever it was, we're selling it. That's what that period looked like. And gold miners definitely fell into that. And to your point, they've rebounded nicely out of that.
They have.
To be determined.
But going back to those rankings, it's still a lot of online retail. Again, we saw that in Amazon this week. Amazon breaking out to all-time highs, had a huge week this week. Very bullish chart over the intermediate to long term. Healthcare, the Qs, biotech, which again clients are well aware of. Software. The top areas continue to be these techie, growthy type areas. Even within healthcare, it's more the medical devices or the biotech, as I said. So if value is going to be a thing, it'll give us the data that says, hey, we're showing up to the party too. We're here. Bonds continue to work their way down. Again, today we talked about that move. We talked a little bit in the client section, that move in treasuries.
Right.
I
We've got a
think that's
scenario
huge information.
scenario in our hands where a failed breakout above 170 and, something like the buns over in Europe, potentially having a weekly double top. And so there is evidence building of potentially higher rates here. Now, we'll take it day by day, and week by week as the information unfolds. But that development today is definitely not something that nullifies that potential thesis. Let's put it that way.
No.
Before we wrap this up, a couple important things I wanted to cover real quick because we're hitting up against our time limit. And some of this we noticed as the day developed today. Now, we've been aware of healthcare stocks being strong, but let's talk about IBB. Let's talk about biotech.
IBB. So we've got and this has been a very closely a big range here. We're talking about
it's a big range.
3 year range.
A 50% range, like a 40% range over 3 years.
We've seen it in the individual biotech stocks. And now it's starting to show itself. Obviously, stocks like Gilead or Regeneron are going to lead the way. But biotech looks very strong.
It's the highest weekly close since 15.
Wow. August 2015. Yeah.
Yeah. So, I mean, it's an important development that you want to pay attention to because basically, I mean, using like an ITF like IBB, biotechs have moved sideways for, let's call it 4 years.
Yeah.
So to have something like that potentially break out is important information. That's something we'll continue to monitor. You posted a really interesting chart on, and we've covered it in the show before, but I think it makes sense to cover the terminology again, and whether you like to call it VWAP or VWAP, volume weighted average price, as quickly as you possibly can, describe what that is, and then kind of what we're seeing in that type of information, both in something like cap index like the S&P 500 and something like a small cap index like the Russell 2000. So can you just talk about or elaborate on VWAPs in both of those areas?
Yeah. So VWAPs, or I guess more the technical term would be anchored VWAP, because we like to use them from specific price points. They essentially tell you what the average person who has bought a stock or an ETF since a certain price date, whether they've made money or they've lost money. And
so, for example, you could anchor something on like March 23rd.
Yes.
And say, well, what's the average price from that date forward?
Yeah. And so in that, right, if you're using a low, right, we would use a high like February 20th as resistance. And we use something like March 23rd as support. And so that says that your average buyer since the lows is still making money, still has made money on their trade, on their investment since they purchased that, right? So
and is that the case in both Russell 2000 and S&P 500 from the low?
From the low, yes.
From the low, that's the
all
case,
the major
right?
indices
still above their volume weighted average price from the low.
Yes, and really still above it from these various gap ups. I mean, from whether you wanted the March or the April 6th gap up is an important one. And all above, the only one that's not above the anchored VWAP from the February 20th highs is the small caps.
Okay, so for example, S&P 500 above its volume weighted average price.
Yeah, so that means the average person who's bought, S&P, even going back to the highs, even if you bought on the days of the highs all the way down,
all the way to the lows, the average price paid, we're above that level.
We are above that level.
But the exception to that is an area that has been weak.
Has been.
And that's the Russell 2000, right?
So
that
Russell
from
2000,
the high, it's actually below that, correct?
And if we can get above that, I think that's some. I mean, I'd say 3 of the 4 major indices is pretty good evidence that broad markets are participating. If we get 4 of the 4 major indices above the anchored VWAP from February 19th, February 20th, whatever you want to call it,
it's important information.
I think that's a huge piece of data that's really hard to argue against.
Oh, absolutely. And you posted a really nice chart about the Russell 2000, the one that's the exception, the one that's still below its volume weighted average price from the highs. So if we can recapture that, because we bumped up against that, and sold off a couple times, and then we can reclaim that important information.
Yeah, and that's fine. I mean, it took the S&P a couple times to get through there. It took the S&P a couple times to get through 2,600. Sometimes you got to tap on the door a few times before they let you in. But again, great close, a great day for the Russell 2000 today.
Yeah. That's the way we learned it, right? The more times you knock, or the more times you're crashing on that barrier, the more likely it is to break. So great podcast today. We're up against our limit, but a lot of good information that we covered. We covered some important price levels. We talked about the VIX, and we talked about the mega names, and we talked about just important levels that have continued to hold in treasuries. Anything else you want to wrap up with before we shut this down?
No. Great progress. I know that there's still a lot of negative headlines over all of this. But again, the market is not the economy. I would harp on that. Again, David, you're probably the strongest proponent of that. Is as great as it, or the strongest proponent of this, as great as it is to have stocks go up and climb this wall of worry, we do have to be prepared that, if 25 of the 50 states are open on March 1st, we might be selling. I mean, the market could have anticipated that.
Right. It could be, right. Price tends to lead. We see it over and over
we
and
could
over.
May
1st happens and we start selling up.
We could have a weak March in stocks as people start to go out and spend money.
Right.
I think people need to be, right. Then that can almost be an equal set of frustrations.
Right. To be that there's an equal amount of disbelief that could happen if May 1st we're reopening things and the market starts to sell off and people are like throwing their hands up and they're like, what?
I just started buying stocks,
right,
and now they're selling them.
Right.
But everything, like, me and my friends are hanging out and we're spending money. We went to dinner, we went to the bar,
right,
we went to the ball game.
There's multiple scenarios. It's why we game plan, because we know that we're not smarter than the market. We don't know what Monday brings as far as the market goes. And so you have to take it on a day-by-day basis, and especially with implied volatility where it is, we're not out of the woods yet. So we'll continue to say that until we have, you could say we have an uptrend on our hands. It depends on your time frame, but continue to use price levels to manage that risk. But to your point, just being open to outcomes. Don't marry your opinion. Don't sit there and say, this is what has to happen. Don't worry about what you think the market is going to do. Just worry about what the market is doing. Yeah. And it'll be fine. So I appreciate all your insights. I appreciate your positivity. We continue to think that we come out stronger in the long run from everything that's going on, whether it's from COVID or whether it's different economic situations where we're reopening or maybe delaying reopening. We do think we come out stronger from all of this in the end. And so I appreciate your insight and time, Ian. We've kind of bumped up against our time. And thanks again for everyone who's listening. Again, hitting new milestones this week, and as the amount of listeners continues to increase. And so we appreciate it. We appreciate the feedback. And we'll do this again in another week. Thanks, everyone.
Thank you very much. Have a great weekend.